Hello viewers, welcome to the show once again. Sir, last episode I was asking about possible mutual fund losses.
Yes. Vanakkam viewers, mutual fund will never cause you any loss. If any of the investor is at loss, it must be of his own making.
What? You mean to say investor losing money on his own? Why would anyone indulge in such activity?
Investors are doing it because of their greed and fear, because of their lack of knowledge in mutual fund, because of their poor planning.
Can you explain it further with examples?
Sure, to understand what is greed and fear, watch this video. Ram investing in a mutual fund in the year of 2009 at rupees 14,500. His friend Ravi, not sure of mutual fund, decided to wait and watch. Ram gaining 4,000 in the year of 2010, 11,900 in the year of 2011 and 16,550 in the year of 2012. Now, Ravi is becoming eager to make a similar profit and buying the same fund at rupees 31,050 in the year of 2012. In the next 3 years, market moves downwards. Ram always in profit despite of the down market, whereas Ravi is in loss in all the 3 years. Ravi wonders what is happening. Year after year, he becomes nervous with this investment. In 2015, his fear overcomes his will and he decided to sell his mutual fund. Ravi sells his mutual fund and end up with a loss of 4,707. Ram continues to hold his mutual fund and eventually at a profit of 20,720. Had Ravi continued to hold the mutual fund, he too might have ended in profit. Same fund, two different investors, one ending up in profit, one ending with loss. Now you tell me whether mutual fund is making the loss or the investor making the loss.
Of course, investor. Now I understand how the greed and fear affecting the investment returns. What knowledge we need in addition to what we learned so far?
You need to learn a very important measure of returns. It's called rolling returns. Watch this video. Here we are seeing a mutual fund price chart. In the last 10 years, this fund returns more than rupees 20,000, that is at the rate of 9.3% CAGR. This is an overall measurement of the performance. To understand the behavior of this fund throughout this 10-year span, we need to measure the rolling return. Rolling return is the return between 2 points separated by a fixed duration. In the example, for simplicity, we take only one data point every year separated by 1 year. That is, from 1st December 2009 to 1st December 2010, the gain is rupees 4,000. Here our next data point is between 1st December 2010 to 1st December 2011. The gain is 7,900 rupees. From 1st December 2011 to 1st December 2012, the gain is 4,650 rupees. In the same way, we are measuring the rolling return of 1 year between two data points every year. After reading all the returns, we can easily find out what is the minimum, what is the average and what is the maximum returns for a 1 year rolling return. The inference that we can make out of this data is, though the fund gained more than 20,000 at the rate of 9.3% CAGR over 10 years, there were low return period and high return periods. The lowest return was minus 6% between year 2014 and 15, whereas the highest return of 43% is between year 2010 and 11. Let us measure the rolling return of 3 years. From 1st December 2009 to 1st December 2012, the gain is 16,550. The same way we can measure between 2010 to 2013, 2011 to 2014 and so on. Now if you look at the summary, that is the minimum and average and maximum, it is slightly different from the previous case. The range is narrowing down here. Let us continue and do the study for 6-year rolling period. Now we are getting totally different picture. The minimum becomes 0 and the maximum becomes 14%. This is actually a gold fund chart. As per this past performance, if someone invests in gold and stay only for 3 years or lesser than that, they may end up in losses. For avoiding any such loss, they have to stay invested at least for 6 years. That is the inference that we can arrive from this particular study.
Okay, I understand what is rolling return. How this will help to avoid any loss in mutual fund?
Different mutual funds having different rolling return characteristics. If you want to avoid losses in mutual fund, you have to choose the fund according to your need. Watch this video. Here we are going to see two different funds with different CAGR. As you can see, the liquid fund is always positive in return. If the investor not sure of his investment period, he can choose this fund. He will never incur loss at any point of his withdrawal. But note that his return will be very low. The lowest expected return is around 5%, whereas the highest return is around 10%, and the average return is around 8%. Now look at the mid-cap fund, which is having an average CAGR of 19%. For 1 year and 3 years, we may get even up to 50% return, but there are also chances of losing 50%. For holding period more than 5 years, the rolling returns always is positive. Look at the 10 years rolling return. The minimum itself is 15% and the maximum is 26%, whereas the average is around 19%. So if an investor is expecting high return, he need to go for this, but he should prepare for holding the fund for at least 5 years or above.
Got it. High return funds are high volatile in nature. So depends on our entry point, we may need to hold it for a long period to see positive returns. What about poor planning? How to address that?
Always discuss your income and your needs with your financial advisor. Together, you have to draw a clear-cut financial goal planning. Once you decided with your goals, you have to choose the correct fund with the help of your mutual fund advisor and start investing in those funds, diversify it correctly and achieve your goals. Until then, keep saving the money.
What are all the different fund categories available?
Let us talk about different categories of mutual fund in our next episode.
Thank you, viewers. Please remember to press the subscribe and like button. Bye-bye.